Hey, what's up guys, Evan here. Wall Street CEOs just issued a dire warning to 330 million Americans about the future of this great country. Biggest banks testified on Capitol Hill today, CEOs of JP Morgan, Bank of America, Citigroup, and Goldman Sachs to stop the Biden administration's proposed changes to regulations. What we are going to witness very soon, we're already starting to see it. We're seeing it with bank layoffs. TD Bank laying off 3,000. Citigroup laying off 24,000 employees. Bank of America just fired 7,500. This just a couple of days ago. Big banks have been quietly cutting jobs, and more layoffs could be coming. When you start to look at all of these bank layoffs, over 50,000 so far this year, you have to ask yourself why. Well, when you look at what Jamie Dimon and these other bank executives are warning, you can see exactly what's going on. And I'm going to break down exactly what's coming and why I think property values are going to fall in a very, very big way. Car values. I believe a lot of assets are going to be greatly diminished in terms of value because of all these new rules, regulations, and changes that are coming to our banking system. I'm going to break it down for you. Please hit the like button. When you hit the like button, YouTube will share this content to educate more people about what's going on. You know, I've been the first one to say that I believe we have been in the greatest setup, the greatest rug pull that ever was. If you started in 2020 throwing so much money out there, letting everyone borrow, then sweeping these new regulations to prevent anyone from borrowing or most people from borrowing. And so what are you going to have? You're going to have a lot of people locked into a ton of debt, and they can't get access to funding to pay for it. What are they going to do? They're going to start defaulting and selling off assets. You want to position yourself to be able to go out there and buy some of these assets. They're only going to likely lend to people with the best credit scores, the best finances, the strongest candidates. That's what I believe is going to happen. Take a look at this. So, Wall Street CEOs try to convince senators that new capital rules will hurt Americans as well as banks. This came out 4 hours ago, CNBC.com. Wall Street CEOs on Wednesday pushed back against proposed regulations aimed at raising the level of capital they'll need to hold against future risk. In prepared remarks and responses to lawmakers' questions during an annual Senate oversight hearing, the CEOs of 8 banks sought to raise alarms over the impacts of the changes. In July, U.S. regulators unveiled a sweeping set of higher standards governing banks, known as Basel III Endgame. The proposals would have predictable and harmful outcomes for the economy and markets, businesses of all sizes, and American households if unchanged. The regulations would raise capital requirements on banks by about 25%. The heads of America's largest banks, JP Morgan, Bank of America, Goldman, are seeking to dull the impact of the new rules, which would affect all U.S. banks with at least $100 billion in assets. It'll take until 2028, so we're going to continue to see bank lending tighten up every single quarter. They go on to say, fully phased in, raising the cost of capital would likely hurt industry's profitability and growth prospects. It would also help non-bank players, Apollo, Blackstone, the big private equity firms, which would gain market share in areas that have receded from because of stricter regulations, including loans for mergers, buyouts, and highly indebted corporations. While all major banks can comply with the rules as currently constructed, it wouldn't be without losers and winners. I thought they wanted to combat inequality, right? Who is going to get access to money? Who is going to have no problem at all? It's going to be the strong businesses. It's going to be the real strong borrowers. The everyday American is going to have a harder time because of all of these rules, all of these regulations. Those who could be unintentionally harmed by the regulations include small business owners, mortgage customers, pension, and other investors, as well as rural and low-income customers. According to Diamond and other executives, mortgages and small business loans will be more expensive and harder to access. Think about this. People are saying, oh, we're going to see a Fed pivot and rates are going to fall. Look, if rates did, Let's just say, for example, rates went from 7.5% now to 5%. You know what would happen? There would be so much home inventory. Inventory would explode. Inventory would explode. And with it, supply and demand would have a very, very big impact on value, right? You would see a lot of people trying to leave their homes when you have 40% of all mortgages in America taken out between 2020 and 2021, locking in 3, 4, 5% mortgage rates. You would see millions and millions and millions of homes hit the market. It would be like a crash, right? But when you add in the fact that it's going to be harder to get a loan, harder to borrow money, and the cost to borrow is going to continue to rise, it's going to be a very, very, very big problem for home buyers, but even more for home sellers as insurance and taxes continue to rise, and the ability to access capital to pay for this mortgage is going to get harder and harder, right? So, you're going to see a situation where they predicted, CNBC, MetLife Insurance, that 40% of all homes will be owned by institutional investors by 2030, right? In 6 years. So when you start to look at this, you're like, okay, well, this is the great rug pull. This is, I believe, the greatest transfer of wealth that we've ever seen. We're walking into it right now. With the rise of cost of capital, government infrastructure projects will be more expensive to finance, making hospitals, bridges, and roads even costlier. Corporate clients will need to pay more to hedge the price of commodities, resulting in higher costs. The changes would increase the cost of borrowing for farmers and rural communities. It would impact them in terms of their mortgages. It would impact their credit cards. It would also, importantly, impact their cost of borrowing that they do. Finally, a CEO warned that by heightening oversight on banks, regulators would push yet more financial activity to non-bank players, sometimes referred to as shadow banks, leaving regulators blind to the risk. The tone of lawmakers' questioning during the 3-hour hearing mostly hewed to partisan lines, with Democrats more skeptical of the executives and Republicans inquiring about potential harms to everyday Americans. Currently, this is according to HUD.gov, right? HUD.yes.gov. They say an estimated 23% of Americans owe more on their mortgages than their homes are currently worth with negative equity. 23%. Now look at where most people are right now. Retirees, people on fixed income, people are barely making it. The cost of living is through the roof. Well, 401k, hardship balances are down. The last resort, hardship withdrawals are up. You have a whopping, which means 30% of their income. This is retirees. Nearly a third of households headed by seniors are considered cost-burdened, which means that they pay more than 30% of their income on housing. Well, this came out of Harvard. This is harvard.edu. Says a growing number of older households are cost-burdened, meaning they spend 30% or more of household income on housing, utilities, and appliances, applicable taxes, and insurance. Nearly 11.2 million older adult households were cost-burdened in 2021. Now, look. They go on to say, property taxes, utilities, insurance fees, all of which contribute to higher costs and therefore to housing cost burdens, can also be challenging for older households. Rising property taxes can be particularly difficult for older adults on fixed incomes and in areas where prices are escalating quickly. Most states offer some form of property tax relief for older homeowners, but the amount of assistance varies, and some require homeowners to pay deferred taxes upon the sale of their home, leaving them lower sales proceeds, which will finance other needs. So, retirees are in very, very, very big trouble. The everyday American is in very big trouble. Capital is about to get much harder to get access to. You have to realize that the next couple of years are going to be the most important to build wealth, the most important to make smart decisions, to get out of high-interest rate consumer debt, to really be strategic. Because as the world gets harder, most people aren't aware of what's happening. So most people are saying, this won't happen. We're going to go back to 2018, 2019. This is your moment, the next 2-3 years maximum, to grow wealth, to put yourself in a really, really strong position. Because consumers, look at what's happening with retirees. So, over 79% of Americans aged 65 or older own their homes. 79%. Right? Well, this is a total of 27 million owner-occupied homes, right out of 33.9 million. So that's a massive, massive sum. And so when you think about these people, they're on fixed incomes. When inflation continues to get much worse, and taxes, insurance continue to rise, many of these people are going to be forced out. Already a third, with present-day expenses, are already cost-burdened. A third, right? So, you look at this. They say, oh, here's what retirees can do. These are their suggestions. Build a diversified income stream of mixed assets, keep debts to a minimum, and stick to a budget. All right, I'm sure most retirees are already doing that. Plan carefully and keep family and other financial obligations to a minimum. Withdraw money at a conservative rate. Okay, they're basically saying you're screwed, right? Consider adding healthcare protection. There is no solution except to sell assets and to downgrade expenses, and that's what a lot of people are going to be forced to do as we start to walk into this problem, because you look at where, not even just retirees, everyday Americans are at. Consumer loans through the roof right now. Well, and consumer deposits are plummeting. So, in August of 2021, consumers had 2.1 trillion, right? And they're now sitting at 190 billion. This is as of September 26th, so about 2.5 months ago, right? So, they went from 2.1 trillion to 190 billion. This does not take into consideration student loans that were due 4 days after this article came out. And so, that means they had burned 1,910 billion in the course of 27 months, right? Meaning that they're literally sitting on 70 billion, that's it. They're sitting on 70 billion. They went from 10 billion about a month and a half ago. At the current burn rate, they're sitting on about 70 billion. So, what does this mean? Probably by the end of this month, if you factor in student loans, even if you don't factor it in, they're probably going to be out of money. So, you look at what's going to happen here. Banks are going to continue to get put under pressure. Consumers are going to be put under pressure. More defaults going to happen, more bank mergers, consolidations. This is going to continue to happen. And they're going to usher this in as a safeguard to protect America. We have to bring in these protections. We have to do this. Look, they don't have to do anything. What's going to happen? This is the rug pull in the American middle class, and people need to be prepared for it. They need to put themselves in a very, very, very strong position. They need to have a business with very, very low expenses. They need to have cash reserves. They need to be really defensive right now. They need to put themselves in a position where they can get loans. Most people won't be able to get loans in the coming few years. You want to put yourself in a position to get loans. 780, 790, 800 credit score, really, really low expenses. Put yourself in a position to where you can pivot and move. That's what you're going to want to do here.